Welcome to The Winning Trade. Each episode in this series will demonstrate how to make money in the stock market, whether the prices are going up, down, or sideways, using high probability, profitable strategies that were designed to take advantage of the volatility of the Russell 2000 and the S&P 500 indexes. Many of these strategies were designed to work together to maximize profits by flowing with the ever-changing market conditions. Follow along as we uncover the secrets of this episode's Winning Trade. Hello everyone, my name is John Locke and I'd like to welcome you to The Winning Trade. But first, the required disclaimer material. This presentation is given for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Please be aware that your risk in trading is substantial, and make sure you are aware of all your risks prior to placing any trades. Also note that we're going to be using hypothetical computer-simulated trades in the demonstration. They are believed to be as accurately represented as possible, but keep in mind that live results can vary from simulated results for many, many different reasons. If this is your first experience with us, my name is John Locke. I'm a trading performance and success coach with Locke in Your Success LLC, and myself and my team help traders win in the market and in life as well. I'm here to guide you into the realm of high probability income trading. Now in a moment, not now, but in a moment, we're going to be going over the winning trade. But before we do, let me quickly explain what we mean by an income strategy or high probability trading strategy. An income strategy is where we put ourselves in a position to generate profits through the passage of time rather than depending solely on price movement to go in the right direction, meaning that we can often make money whether the price goes up, down, or sideways. Now, this doesn't mean we're going to win all the time, but it does mean that the probabilities of us winning are much higher than they may be otherwise. Now, when you find that you want more information as you're following along, simply contact us at Locke in Your Success. That's LOCKE in yoursuccess.com, or ask a question in the comments on this video, and we can direct you to where you can find more information. Okay, let's move on. The winning trading strategy we're looking at today is called the Rock. The Rock has been and continues to be our best performing rule-based income strategy by far over the last 10 years. And that's because the Rock is what we call an adaptive strategy, meaning it's traded differently depending on implied volatility skew, which is why it performs so well over such a long period of time. And if you don't know what implied volatility is, that's perfectly fine. Just sit back and enjoy and try to get the concept around what we're doing. Now understand that the Rock is a rather advanced strategy, meaning that if you're new to income trading, you may have challenges following along. But have no fear, we also have very simple and effective strategies for newer traders as well. And you can see those by going to thewinningtrade.com and discovering our past episodes. And we also have lessons for complete beginners for those who'd like to learn how to profit through income trading. Now in this example of the Rock, remember this is an advanced strategy and that the market environment during the trade demonstration period was not particularly friendly, meaning that the position was adjusted quite a bit. Therefore, in order to get through the demonstration, we'll be staying with the major concepts of how the trade and how the position works, and we're going to save the exact rules for when you're ready. Okay, so this is a trade that we do in the Russell 2000, and for the purposes of demonstration, we're going to use a $50,000 trade size, which is admittedly rather large, but keep in mind we can trade this with as little as $5,000. Now this trade is entered 30 days to expiration. The position has a profit target of $10,000 in 30 days or less, and it has an exit loss trigger of $10,000 as well, and that is approximately 20% of our planned capital. This trade is entered 30 days to expiration, and 30 days for expiration for our September expiration is August 21st, which you see the date right up in here. This is what our entry looks like. Now, for those of you who haven't seen this, this is a software package called Option View, and these are our option strikes that are available on the Russell 2000. And this shows us the strikes that we're buying and the strikes that we're selling. So in this case here, we're doing what's called a butterfly, where we sell, in this case, 20 options contracts at our 1490 strike, and we buy 10 at our 1540 strike. We buy 10 at our 1440 strike, and then we buy a call at the 1400 strike, and we do that to kind of flatten out what's called our delta number, which is right here. If we take a look at what this looks like on a risk graph, what we have here is we have In the bright red, we have our expiration graph, and the dashed line, the dark red dashed line, is what we call a T plus 0 line. Over time, the dashed line goes towards the solid red line, in theory, and we make money. Now, the asset price goes along the bottom, and the profit and loss in dollars is on the left side here. So currently, with this position, we have a butterfly and a call. Now, this trade is not always entered this way. This trade is entered differently depending on what the implied volatility situation is in the marketplace. And the way we tell how the implied volatility situation is in the marketplace is we look at a symmetrical butterfly. It's one way of just hacking what's going on. So if I were just to pretend to remove this call and take a look at our position, it looks something like this. You can see the steepness of this line at the price level. That is essentially what your delta is. If I have a very high negative delta or a very high positive delta, the line will be very steep. If I have a delta near 0, the line will be very flat. So in this case here, you can see the line is clearly pointing down, and it's pointing down at a rate here with minus 107 delta. So we're going to come in here, we're going to buy a call that gives us some, in this case, 92 delta. That's going to shave that off, and in this case, we're entering the position with about minus 15. So you can see that it's relatively flat now. Now, from here, if the position gets in trouble to the downside, in other words, the market moves down too far, what we're going to do is we're going to take this butterfly position and we're going to move it back. We're going to move it to a lower price level. And if the market goes up too far, then we have some adjustment techniques there as well. And the type of adjustment we're going to do is depending on how the volatility shifts during the duration of the trade. Like I said, this is an adaptable trade. So if the market situation changes from an implied volatility standpoint during the trade, we'll switch to more of a condor position. And that'll happen later in this trade, and we'll kind of show you what that is. So let's kind of get moving here. So it's August 21st. And this is our current position. If we move ahead just 2 days, right, we'll move ahead 1 day first. We get a bit of down move, no big deal. We actually get drawn down a little bit. This profit and loss fluctuates, nothing to be too concerned about. But if we go to the following day here on Friday, we get more than a 40-point move in the Russell. It's 44 points. Those are very rare. They've been a little more common recently, but in general, they're very, very rare. And it's a really big move. And that being the case, we had some implied volatility stuff going on, and the market price went from way up around 1510 where we started all the way down to this 1460 level. If we take a look at this on an analyzed graph, all in this position, all our risk is down here. And when we get back in the butterfly like this, we want to do something about that. So in this case, we're going to do what I said. We're going to roll this back. So we removed, we'll put this back again. We removed our butterflies at 1490, and we brought them all the way back to 1440, which is very similar to our starting position, except now we're drawn down some. But this is what our new position is going to look like here. If we go from the 23rd and we sit in this for about 9 or 10 days here, going all the way to the 3rd, not a whole lot's happened. We're still drawn down. And what happened in the marketplace is we had this really big down move right off the start. And then we're starting to consolidate, not making a whole lot of progress on profit and loss just yet. But here is what we look like here. If we move ahead to the 5th, we get in a situation where the market's gone up a lot. So our butterfly here is between 1390 and 1490, and the asset price is all the way up here around 1520. And this is what our position looks like. We got too far outside the tent. This was a big update too. We just had a 30-point up move this 1 day. So it shot us way up here in the tent, or outside the tent, I should say. So we're due for an adjustment. So here, what we're going to do is we're going to pick this butterfly up. And at the same time, we're going to do what's called an entry test. So I want to see what the implied volatility skew is actually doing in the marketplace. And again, I can check that by looking at my butterfly. So if I just neutralize this to a normal butterfly position, I get something like this. My delta, or the steepness of this line, is not really steep enough to go into the type of position that I might be looking for. So I'm going to stay in the same butterfly call position here. And this is what our adjusted position looks like. So we've gone from here, this old position in blue, to the new position in red. Now, as we move forward to the 9th, some of our profit starts coming back into the position a little bit, where, or at least our losses are being reduced. And this position here has a maximum delta inside the tent of about minus 100, and where this dashed line is getting a little steep. So to correct that, we're just going to put some verticals. We're going to move some of these 1500s up higher. So you can see we brought 5 1500s up to 1520. We're now minus 30 in our delta range, and we have a new position that looks like this, as opposed to the old position that looked like that. You can see we flatten that out. We go the next day here. We got a 15-point up move. We have our delta at this point, it's minus 77. Again, this is a little bit high for being outside towards the edge of the tent. We have different delta numbers depending on where we are in the position. At this position here, we generally don't want to be over 75. We're at 77, so we'll make a minor adjustment by bringing some of these 1510s up into the 1520 area. And now we're at minus 46, so that brings us to something a little bit more reasonable. If we go to the 11th, we get another rather large up move. We're gone up 30 points, which again is a very big move for the Russell 2000. We're drawn down 1700 at this point. We are, if you look at our analyzed graph, we are way outside our tent here. And again, this is going to call for another adjustment. This time when we adjust, we will do that entry test up in here. And we'll find that the delta is much, much steeper. So just for an example, again, these aren't going to be the exact numbers. There's a certain process that we have for checking it. But if we were to take a look at this, on its own, this is getting very, very steep here. This is getting very steep. And our delta number at that point is 242. So when we get up over 200, then generally we're going to convert into a different type of position, because at this point, we're looking to maximize theta at this point. So what we do in this case here is we're going to bring some butterflies up in to the 1560 level, and then we're going to add some butterflies up here 40 points higher at 1600. So if we take a look at the new position, the new position has a delta of about minus 80. We now have different delta rules than we did before. So this is going to be considered almost a completely different type of position or different situation. And we're down about $1,800. And this is what our position looks like now. It's more of a condor type of a position. So if we go from here, it's the 11th. And the great thing I like about these positions is they gain money extremely quickly. Let's go to the 13th. Right, we're almost getting back to break even here. On the 16th, what happens is our delta starts to get too high again. So our maximum negative delta in this type of positioning is minus 250. We're at minus 291. If we look at our charts, you can see that we're sitting right here. And in this case, we are due for an adjustment. So we're going to come in to adjust this. We're going to add in some butterflies up here at the 1600 level. We're trying to get this down under 200 at least, or right around 200. And this brings us down to 202. Now we could start adding some contracts if this isn't low enough for us up at the 1620 level. In this particular case, if we do that, our delta gets a little too flat. So minus 202 works here. and here is our new resulting position. Right, the blue was our old position, the red is our new position. If we move one more day, you can see how fast the money comes into the position. We are now up $4,791. And here's what the position looks like here. If we go forward one more day, the market is starting to come down again on us. Now, at this point here, we have a delta that's too positive. In other words, 375. If you look at our analyzed graph, you see the slope is in the other direction. We only allow around a positive 100 here. So with 3 times that being the case, we are going to pull out of some of those butterflies at 1600 that we added earlier on. And let me pull out of that. And that brings our delta number down to about a positive 86, so that is within range. And then if we move ahead one more day, oh, and this is our new position, by the way, this is our new position. And if we move ahead one more day, we can see the markets come down a little bit, and we have at this point exceeded our $10,000 profit target. And even if we didn't get to the profit target, we are on expiration day. So essentially our last trading day for these options is going to be this Thursday, and they're going to expire the following morning. So this being the case, we would exit this trade regardless. But if we take a look at our analyzed graph, this is where we sit, and we're over our profit target number, we're out of time, and we exit the position at a profit of right just about profit target of $10,000 or 20% of our planned capital. And that was the rock strategy, this episode's winning trade. If you like what you see, I encourage you to join us and discover how you too can follow along with this and other great strategies as they unfold during our weekly Options Trading for Income webinars, and where you can also learn about upcoming trade presentations as well as explore past winning trades. And perhaps even best of all, you can get information about our free Trading Performance podcast where you can learn to become a much more effective trader regardless of the type of trading you do. If you have any questions or comments or anything you'd like to see in the next winning trade, we'd love to hear from you. Simply comment on this video below so you can get those burning questions answered. And we would also encourage you to come on over to thewinningtrade.com. That's thewinningtrade.com, where you can find past episodes of The Winning Trade as well as a lot of other fantastic information on how to profit through income trading. Thank you, and we'll see you on the next winning trade.